Last I got that sinking in my stomach from that loss. Of course it's got me thinking's got me flummoxed from the cause. I just wanna know why some of us are guarded. I just wanna know why some of us are haunted.
Hey, what's up guys? It is John Fibonacci. Welcome to my YouTube channel. Hope you're having an amazing day. Make sure that you guys are subscribed so that way you don't miss future content, and also make sure you're following me on Instagram at John Fibonacci. All right, so today we're going to talk about the secret to fractals. All right, so the fractal indicator definition and applications can be found on investopedia.com. If you go to the dictionary or just look up fractal, I'm sure this will take you there. As a matter of fact, I will leave the link in the description so that way you guys can go check this out for yourself. And I'm not really going to read everything, just like in my previous videos. I show you guys the definition on Investopedia, but I'm not going to go through all that. Plus, there's a lot more. You can scroll down and read more of it if you want to. But basically, if you're not familiar with fractals, well, here you go. Okay, the bullish fractal pattern signals the price could go higher. Bearish would be opposite. All right, but there's two takeaways that I want to point out to you. So the first one is the bullish fractal, okay, occurs when there is a low point with two higher low candles on each side of it. So what that would look like is this right in here. So if you've got a candle that has a low point and then two candles on both sides of it, that basically means you have 5 candles altogether. Now I've seen people do 3 candles. If that's your thing, that's your thing. I've used both. Okay, you know, sometimes 3, sometimes 5. Honestly, it doesn't really make that much of a difference based on what I've studied, but I guess if I had to say, I do prefer 5, and that's at least the way I guess the indicator is designed, so that's just what I'm going to stick with. All right, but you notice here that there's a candle that makes a low, right? If you look at the wick here, and then 2 candles on the left have higher lows, right? This low is higher, this low is higher, and then the ones on the right as well. Low, but it's higher, and then low, but it's also higher. It's kind of like a U-shaped or a V-shape, if you will. So the bearish fractal is going to be literally opposite, okay, or inverse, if you will, where there's going to be a candle that has a high, right, the highest high, and then the 2 candles to the left are going to have lower highs, and the candles to the right are going to have lower highs. So I think it's very easy. It's basic. It's not that complicated, but there are a certain points that I want to make throughout this video that I think are going to help a lot of traders out who look at fractals. I don't always take a trade with these. Sometimes, though, if I actually look for it and point it out, it helps, okay? Some of the best trades I've taken on pretty much every time frame has fractals more so than not. Like, more often than not, there will be a fractal low or a fractal high that forms in certain places, okay? All right, so here we're looking at the micro E-mini S&P index futures. If you looked at the video already of the importance of New York Open, right, the New York Stock Exchange Open, you saw this exact setup. but it's important, and I want to go over it a second time so that way you understand kind of why the low's being set, right, and when it's being set for the day. Okay, so another issue that I see with traders, pretty common mistakes, and I've done this too, and sometimes I still do this once in a while, but traders will like to try and catch the bottom, and sometimes I have found, more times than not, that it's better for the market to form a low and then buy a retracement, or let the high be set and then shorter retracement higher to go lower. Okay, so I'll go ahead and show you what the fractals indicator looks like, and this is why I don't put them on my charts, because it obviously dirties up the chart. And the biggest problem with fractals, or at least with the fractal indicator, is that it prints so many of them, right? It prints a lot, and obviously the lower time frame you go, the more fractals you're going to have. So like on a daily or weekly time frame, you'll have less, probably, at least on the chart. I guess it really depends on how much you zoom in or out, but you'll notice if you actually pull this up on your charts, and there's some higher time frame examples we're going to get to in just a minute, but ultimately, all in all, the biggest problem with the fractals indicator is how many that it actually produces, right? Because the indicator counts obviously every candle, so every single formation it's going to print a fractal. So the secret, I guess if you want to call it that, the way that I see it, it's about when and where that fractal forms, right? Not just every single one. There's got to be some type of filtering process when you have this many, signals, I guess if you want to call them that, so many fractals forming. Obviously 99% of them, or whatever the case, are going to be not as beneficial as others, right? So you want to find that one or two that makes all the difference. So that's when the context and context of when and where and why that fractal forms, I think is really the most important part. So I'll go ahead and show you where in that video we talked about the support seen here, that traders during the London session view those lows as support. So when the market actually opened, right, that's what this indicator does. This is my John Phibbs London Open, or excuse me, London and New York Open, right? So the market had opened, rallied up, and then slammed lower. So when the market basically ran stops shortly after the open, and then price rallied up again at the formation, or at the close of, I guess, the second bullish candle, I'm assuming is when this, or at least the indicator, would basically say, hey, you know what, this is a fractal low. So what makes it, what makes this low different from like these others over here, right? And that's what I'm saying. It's the context of that the market manipulated for stops here and then rallied up. So price showed a significant reaction from this area with the proper context, okay? So if that fractal low forms, then there is a good chance that this is going to be the low of the day. Now, is it always going to be that way? No. Sometimes price will continue lower. It all depends on other things, right? Every trade is different in a way, okay? Well, technically, by definition, yes, each trade is different because it's different time and data. But I mean, like the setup, I mean, there's so many things to take into account, into consideration. So higher time frame bias, market news, day of the week, all these other different things, right? But just to keep it as simple as possible, it's the context of where this forms, right? So it forms where this manipulation happens, right? When it's right after the open. That's what George Angel talks about. in his book is that, at the open, price runs for stops. We see that here. Okay. And then just like in the video, I showed you that once this high was formed, not the fractal high, but I'm just saying once this short-term high was formed, the market came back down, that this was a potential retracement for a buying opportunity, off of some type of Fibonacci level or something like that. And then if you were managing this trade, like say you got in here somewhere, right? A little bit of drawdown, whatever. But then if the market's going your direction, another fractal forms here and on the way up. So at least there's that as prices continuing into your favor. So we actually see a little bit of a reversal in here, right? So if you look at the context, this fractal high formed above the open. Price ran, however many points that is. And if it was ready to, obviously cool off a little bit, a little intraday reversal, you see that same significance here where price came above the open, was rejected, and then came back up, was unable to move past this fractal high, and then traded lower. All right. So it just kind of depends on how you look at it. But I think that's the secret right there is understanding context of when, where, and why they form. All right. Now this is a 5-minute time frame. I look at indices on the daily, 1 hour, 15-minute, and 5-minute. But there it is. All right. So obviously explore multiple time frames if you're going to backtest something like this. All right. So here is the S&P 5-minute again. And this was a trade that I took the other day. And I want to explain a little bit more on why I took it. All right. So if we go ahead again, adding the Fractals indicator on here, and just in case anyone is wondering, I didn't change any of the settings except for the colors. Okay. I don't know what the colors were, but I wanted the green to represent fractal lows and the reds to represent fractal highs. All right. But other than that, no settings were changed. So if you're going to add that indicator to your chart, the settings are the same. Okay. But I remember this, it was very recent actually. So this trade, basically when the market's falling, right? Like the market's trading and then it's falling, this by definition is a fractal low, but you don't get a massive response to the upside. It only prints like 2 small up candles and then immediately continues to trade lower. And so if you were trying to, buy this, like, oh, the fractal low formed and you bought that, you got crushed. And this is why I said it's better to wait for the low to be set sometimes and then getting in on a retracement. So we actually see that here where around 12 o'clock we see a fractal low form, price trades higher, we get a retracement here, and then this is the expansion to the upside that I feel is a little bit more important, right? Because you had a lot of bearish movement, and then you actually get price, it prints these up candles, trading higher than these fractal highs, trading up. So that to me is now a sign of, okay, we might have made the low of the day, and we can look to take a long position at a retracement to go higher. And that's pretty much what happened in here. All right. So if we can add a little bit more context. Okay. So I know a lot of traders who like break of structure. I think it's okay. It's again, I think break of structure does require some context and some other things, not just break of structure by itself, but I always try to put these in here, at least in my presentations for my students at the IM Mastery Academy. I put those in there because, people like it. So we have one here, right? And again, these fractal highs or even the candle bodies or even the candle high, however you want to look at it, there's a break of structure here. So on an intraday basis, at least for the second half of the day, right, the afternoon session heading into the close at least would have some type of short-term bullishness. So we go from around 14, or excuse, I don't know why I said 14, 44.22 up to about 44.45. So not bad. All right, this week we've actually seen some heightened volatility. There's some stuff going on in the world and all these news and stuff like that. So I think markets are a little bit more volatile than normal. And just for sake of clarification, today is the 18th of August, 2021. So if you're viewing this video after today or tomorrow, then you can go back in your charts and you can see that the daily candles from this week have been in a bigger range than the last couple of weeks or so. So markets have been volatile. Okay. And here is that 61.8% retracement that I was referring to, right? When you have some type of buying opportunity, right? Looking at that 618 or possibly the 786 level, we see that the 618 was met down to the very point here. Beautiful to trade higher. For sake of clarification, I actually got in a little bit above the 618 level. All right, there's some smaller time frame stuff in here. You can go check it out if you want to on your own charts, but all in all, there it is. Okay, so buying opportunity after the break of structure, and the obviously it's a video about fractals. I got to include fractals in here too. This fractal low I didn't think would be taken, and this fractal low I didn't think price would come down here either. I anticipated that this was going to be the low of the day and that we were ready to go long. Okay, so again, not trying to catch the bottom, waiting for the low to be set and then getting in on a retracement. I think, at least in my results, I have found better results by doing that than trying to catch the low of the day. Okay. All right, so here we have Walmart, and this was a stock that we were looking to study back in March, and this was a stock that I actually had traded for myself, both the shares and the outright options as well. We took some call options back around the middle of March. So although price did take 5 months, something around that, to actually get to where our target was, it was pretty fun, but of course, some fractals were involved with that. So if you actually walk through it from left to right, we see that there's this little E down in here at the bottom. E stands for earnings. TradingView prints these little time stamps, these little markers that present where earnings reports are at. Okay. So back in February, around the middle of February, they had an earnings report and it really tanked. And then it sold off, sold off, sold off, sold off. So when we saw this rally up here, it was basically, in my understanding, that this would be the low. We would look to buy a retracement in here, and our ultimate target was going to be this gap fill. All right, and Walmart's a little bit different than most other stocks, not in terms of, just because it's Walmart, but the fact that it's also a part of the Dow Jones. So that to me does make it a little bit more significant as well versus other stocks that are not in the Dow or the NASDAQ. Okay, so there it is. But this is what it looks like. If you actually put the gap fill as the target on here, that retracement opportunity that I pointed out, and then of course, obviously I don't want you to look at every single fractal, but when we anticipated that the low was set, that was also a fractal low. The entry that we had in here ended up being a fractal low as well. So being able to capture, a couple of weeks of momentum like this, right? A lot of up candles, very small, or at least small down candles, and small number of down candles, excuse me. The options, call options, can get pretty crazy, all right? And in terms of like premiums and volatility premiums or whatever and all that business. And then we actually saw that again for this earnings report here. We had that nice gap up. So I know it's kind of weird because it's a down candle and then a higher down candle, but that's what it is. There was another earnings report. They gapped higher and then closed lower than they opened. So this is a down close candle, but the options in here were pretty nuts as well. So anyways, after that, obviously the market from there did come back down, all right, near the middle to end of June. But then eventually, if you had enough patience to hold until August and then a little bit after, we eventually traded to that gap and actually beyond that gap up to 150. So if you're a long-term trader or a position trader in stocks, Walmart did pretty well. All right, in terms of percentage, it wasn't a lot. From like 130 up to 150, that's only like $20 a share. So again, it's not a lot, but the options is how you're able to get a much better potential return on investment. Okay, less margin, higher reward potential. Okay, so but we're not going to get into all that today. The whole point was just showing you the fractal, okay, down in here. So not bad. All right, not bad. All right, so we're looking at the New Zealand dollar on the daily time frame, right? Kiwi, if you will. And I want to kind of walk you through this from the daily all the way down to about the 1 hour or so to kind of explain, why we were bearish up in this area. And I'll go ahead and show you that. So this area in the orange shaded box, we were looking for short positions in that area. And then we did get some bearishness, and then obviously the market did come back up again one more time. But the last 4 days, New Zealand dollar has really collapsed, and that's very interesting. But excluding that from this, what we're going to do is actually go into this area here to look around to see what's in this. So if you actually look at the daily candle here, right, you see how we got like some up movement, and then on this day here, price opens, right? I guess it trades lower, and then it just rallies all the way up to this point above 70.80, and then comes all the way back down below 70.40. So to me, when I see a candle like that, where you've got a small body but a very large wick, that to me is important. So if that happens after some up movement in the markets, this to me is the first sign of a potential bearish market. Okay, and you can actually see that a couple times throughout this chart. If you actually look back in here as well, you see this candle here and massive wick to the upside, and then all the way back down to close bearish. You can actually see that price does trade lower after that happened. All right, and the inverse is actually here, where you saw long wick to the downside and then price traded higher. Okay, but it's obviously a lot more than just the candlesticks. I'm not a fan of candlestick patterns or like dojis and dragonflies and train tracks and dragons or whatever else they got, but it's context. Okay, so that's the kind of the first point, is understanding, all right, this to me is not bullish, so we might be bearish. But let's drop down into a 4-hour chart and take a look. All right, so here's what that 4-hour chart looks like, and it's a little bit different. You don't see that rejection as much on the 4-hour that you do on the daily, but this is again why the top-down analysis is important, starting at the higher time frames, working your way lower. Okay, so what we'll do is add some fractals here, and it's not that many of them. The 4-hour candle, or excuse me, 4-hour time frame here doesn't print a lot of them, and there's only a couple. All right, but you'll notice that the wick on that daily time frame, right, the high of that candle was right here. And so after that occurred, after a few more 4-hour candles have printed during this smaller time frame consolidation, we actually get a fractal high that forms here, right? And so it doesn't look picture perfect like how I showed you earlier in the slideshow, but you do have the highest point and then the candle to the left, right? The two over here are both lower than this one, and the two candles to the right are obviously way lower than this one. So fractal high is printed there. And then as the market traded higher, this is where we were looking for short positions, but we can actually drop down into a 4-hour time frame, or excuse me, 1-hour time frame, and take a look. So this is what the 1-hour time frame looks like, and that rejection is seen a little bit better, I guess, or at least has more significance on that 1-hour time frame because of such of a quick rejection lower. And this is that retracement higher to trade lower. But on the 1-hour time frame, if we add our fractals, okay, it prints a little bit more, right, than the 4-hour time frame does. But again, we're not looking for all of them. We're not looking at every single fractal in the market. We're only paying attention to this one up in here. Why? Because this one was the one that was printed on the 4-hour, which would have printed, I think, somewhere in this area here, right? And it's the fact that it's a 4-hour fractal, but it can also be seen on the 1-hour. So it's kind of a combination, 4-hour and 1-hour fractal high. So you see how price overextended it is, where obviously you have like 69.60 down in here, and then price rallies up, retracement, rallies up, small retracement, and then rallies up again. So I mean, there's no like measurement, like distinctive measurement. It's just looking at it saying, hey, you know what? Price has rallied for quite a bit. It looks overextended. Price rejects from that area rather quickly. So when we trade back up into this, we should start looking for shorts. Okay, that was the thought process as that was unfolding. So now we can actually clean up the charts a little bit. Okay, no more fractals or orange boxes or anything else except for the fibs. Okay, and you can obviously add your own type of analysis as well if you want to go back into your own charts, like I suggest to do. But we can see that when price came back into that 618 area around 70.70, it right in here, it no longer wants to trade higher. Okay, it's struggling in that area, and then we obviously see what happens next over the next couple of days. Okay, so this was also a trade that I took right near that 618 level, but I do remember this trade, and I actually got out the next day because it wasn't really rallying the way that I wanted it to lower, actually, or at least break down lower. And it was the next day that had level 3 news. If you go to forexfactory.com and you check out the news, I think it was FOMC or cash rate or whatever it might have been. And I didn't want to hold my trade through the news without being too far into profit. So since I wasn't able to get a lot in those 2 days, I went ahead and just got out of it with, it was like 5 or 6 pips. And that's after spread. So call it a break even if you want. Not a win in my book, but nonetheless, if I was more patient or if I decided to hold it through the news, this was the outcome, and this was the original analysis. So this is a 1-to-4 risk reward ratio with an entry at the 618 and a stop loss at the fractal high, right? Anticipating that the high has been set for a while. All right, that was the anticipation. Okay, so some people ask me, where does your stop loss go and things like that. My stop loss was actually a little bit below that. I actually framed a 1-to-5 in here, but I'm showing you a 1-to-4 just because it's a 20 pip stop, and that's not large, it's not small, it's kind of just for day trading. I think a 20 pip stop is normal, I guess. Like, that's average, I guess. I don't know. But either way it goes, risking 20 to make whatever 4 times that is. All right, so there you go, 1 to 4 risk reward printed there. And if we had decided to hold on to it to today, which I didn't do, and I really wouldn't do that, seeing the market trade all the way up near the entry, I would have not held on to the trade at this particular point. But just to show you some of the significance of what the higher time frame can do, because remember, we started at the daily. We dropped down to the 4-hour. Okay, and then now that we're on a 1 hour, but we see what the market has done from around August 4th, 5th, all the way until today, which is the 19th. All right, so this, I believe, is a 1 to 10 at the moment. So again, not a trade that I took. I didn't hold it this long, but just showing you the significance of the higher time frame bias and what it can do on the smaller time frames. All right. So with that being said, that is going to be all from me and for this video. So I hope you guys were able to learn something and take something away. I wish you guys an amazing rest of your day. Be blessed, and I'll see you in the next video.
What do you tell my